In this video, I'm going to explain how the Mega Backdoor Roth works and how it differs from a regular Backdoor Roth and how you can benefit. Okay, so the regular Backdoor Roth has to do with IRAs. A Mega Backdoor Roth has to do with employer-sponsored plans, okay? So to start, let me just kind of review how it works with IRAs. And if you look at my chart here, or my screen, depending upon your age, you can contribute into an IRA up to $7,000 if you're under age 50, $8,000 if you're over age 50. And you do have to have earned income to contribute. But unless you're married, you can have one of the spouses could have no income and they can still contribute. So a married couple, for example, under age 50 could contribute a total of $14,000, over age 50, $16,000 into an IRA or Roth IRA or some combination up to those limits, okay? Now, the problem is with contributing directly into a Roth IRA, there are income limits. So people who have higher incomes, and there is a phase out range, right? So if you're single and you're making more than $150,000, you get phased out of your ability to contribute directly into a Roth IRA. And then if you're married, the number is $236,000. And so it doesn't mean you can't get your money into a Roth IRA. It just means you have to use the back door instead of the front door. So the back door, what you do is you just go ahead and make the contribution. It's an after-tax contribution into a traditional IRA, and then you can turn around and convert that to a Roth. So the end result is still achieved. Now, with IRAs, there is a pro-rata rule if you have other IRA assets. And so there are some other things to take into account. And I'll have a video linked below that goes into the pro-rata rule. But the pro-rata rule only applies to IRAs and backdoor Roth, where the Mega does not have any pro-rata rule issues, okay? So we're talking here for the Mega Backdoor Roth, we're talking about employer-sponsored retirement accounts, such as 401ks, 457s, maybe you have a 403b, maybe you have a TSP. There are different names, but they're sponsored by your employer, okay? Now, the thing that's nice about these is that the contribution limits are much higher, a lot higher than most people realize. The total overall contribution limit, if you're under age 50, is $66,000 as of this year. And for those over 50, it's $73,500. Now, so there's three different types of contributions you want to be aware of. There is the pre-tax, there is Roth contributions, and there are after-tax. So there's three different types. And so the limits of $23,000 if you're under 50 or $30,500, those are the limits for pre-tax and Roth. So you can only do that if you're looking for that tax deferral. But beyond those limits, you can go all the way up, like I said, to $66,000 or to $73,500 with after-tax dollars. Okay, so how that works is, let's say that you're going to max out your 401k with pre-tax. You're putting in $30,500. This is someone who's over age 50. But you do have to take into account the employer portion. So if your employer is giving you a match, that is included in that overall limit. So $73,500 is the max, including the employer amount. So in this example, let's say we're maxing out the pre-tax. The employer, let's say their total contributions for the year is $10,000. And then that gives you another $33,000 that you could put in after tax. That gives you the total of $73,500. Now, the thing with this after-tax money is it can be rolled into a Roth IRA, or it can be converted into a Roth 401k. So it depends on the plan. So every employer's plan is a little bit different. Some of the, there's a lot of things that are the same, but they do have some things that are allowed and some things that are not allowed depending on that employer's plan. Most employers, if you're over age 59 and a half, you can do what's called an in-service rollover. So you could do that after-tax contribution, in this case, $33,000, and you could just roll that right into a Roth IRA. It's a beautiful thing. And then from that point on, you have tax-free growth in that account forever. Now, some plans do offer what's called in-plan conversions, where it's all done right within the 401k or the employer plan. And so you would just contact your 401k administrator and ask them if you're able to do that. But you just want to be careful because there are some, there are a lot of rules and things that you could end up making a mistake and end up creating some taxes that you weren't expecting if you're not sure of what you're doing there. Now, you may be thinking, well, where do I get the money to make these large contributions, right? Well, so it's obviously going to be for people who have higher incomes, maybe business owners, but it's not necessarily just that. I know a guy who had, he made about $100,000 a year from his job, but he had a 1967 Corvette. It's a historic car he had had for many years in really great condition, and he reached a point where he decided to sell that. He sold it for more than six figures, and he had this chunk of money, and he wanted to use that money for retirement, and he wanted it to be in a tax-advantaged account. Well, how do you get it into a tax-advantaged account? And so the Mega Backdoor Roth is a perfect solution. So in his case, what he did was, for his income and expense needs, he would use some of that money from the sale of the Corvette, and then his salary, much larger chunks, he was contributing into his 401k. And he was able to use the Mega Backdoor Roth to get a significant chunk into Roth, okay? So it doesn't mean you have to be a high income earner every year. It could be one-off years. Maybe someone inherited some money and they're like, well, how can we get this more of this into a tax advantaged account? This is one of the ways you could do that. Now, I know we talk a lot about Roth and tax-free and pre-tax accounts, and most people have most of their money in pre-tax accounts. And pre-tax accounts, they're not great for estate planning. You lose a lot of money when it passes on to the next generation. There's more unpredictability with the taxation and with required minimum distributions. And so Roth is desirable, but there's so much money, most people have most of their money in tax-deferred accounts. And so you don't need to have no money in tax-deferred accounts. Sometimes people feel like, well, I need to get all my money converted into Roth. And that's not necessarily the case at all. Because there is a sweet spot, right? When you put money into a tax-deferred account, you don't pay tax on it. The money grows tax-deferred over time. Some of that can come out tax-free, and it's offset by the standard deduction, right? So right now, a married couple, the first $30,000 that comes out is offset. It's tax-free. If you're single, it's $15,000. So you definitely want to make sure you've got the right amount. You'd end up paying too much in tax if you were to convert everything or just go all Roth 100%. But there are times when you maybe want to be 100% if you have like other taxable sources of income, like if you have rental properties and other, pensions and things where you're going to be using up that standard deduction. And so you want your other money to be more tax efficient. But anyway, what's right for you? It's really about getting the right balance. It's about not having too much in a tax deferred or pre-tax account, and having some diversification, having some in tax-free as well. It's really smart to be diversified from a tax standpoint. So anyway, this is how the Mega Backdoor Roth works. There's another concept that I think a lot of people are not aware of. Just to come back to the IRA and the pro-rata rule. What that is it's when you make a contribution, an after-tax contribution, and do the Backdoor Roth, and you have other IRA balances, then that after-tax amount is now inside of a pre-tax account. So you have all this pre-tax money, and you got a little bit of after-tax. So that after-tax amount is now basis. And you use tax form 8606 to identify that, so you don't have any double taxation. Unlike the Mega Backdoor Roth, the employer plans you can have pre-tax money, you can have after-tax money, you can have Roth money, and they can be separated and put into Roth accounts, put into traditional IRA accounts, and you can separate the two, and which is great. With IRAs, they don't allow that. That's where the pro-rata rule comes in. So it's forever mixed. I mean, some of your IRA is pre-tax, some of it is after-tax. And so it creates, you've got to track it. And can you ever separate it? And most people would say no, but there is one way that you could potentially separate your after-tax and your pre-tax and get that after-tax rolled into a Roth. And how you would do that is if you have an employer plan that will accept a rollover and you roll your IRA over, and then once it's in that employer plan, now you can do that separation. And you can roll and break out the after-tax dollars into the Roth IRA. So anyway, hope you found this helpful, and I look forward to seeing you in the next episode of the Financial Fast Lane.